Welcome to the third video of Financial Kahua or Financial Foundations. We have guest speaker Matt Parr from Gather FCU in Kauai. He comes with lots of knowledge in the financial industry. He is currently a branch manager, has worked in the loan office, and as well as financial counseling. Please share the importance of credit with us.
And why credit's important or why it's useful to have good credit. So the better your credit is, the cheaper money's going to be for you in the future, the easier you're going to qualify for stuff. So you don't ever want to go to a dealership, see a car you like, try to finance that car, and then find out that you're paying 18% because you've never had a loan in your name before. So number one, you don't want to be paying too much for whatever you're doing. Without credit, you can't really do anything. You won't qualify for a car, you won't qualify for a home. You'll have to have cosigners for everything. And if you want to be independent, like most people want to be independent, then having good credit is the first place you start. And score between about 300 to 850, depending on the credit bureau. And 35% of that total credit score is just based off of your payment history. So if you make on-time payments, you're going to have decent credit regardless of anything else you do, making on-time payments. And a good trick is it doesn't matter if you're a day late. You only affect your credit if you're over 30 days delinquent. So if you're constantly 5 days late, 6 days late, that's not going to affect your credit score. But it might affect that institution's willingness to lend you money in the future. So if you're constantly 2 weeks late, you're going to have a good credit score, but they might not give you another loan after that. So having on-time payments is definitely the most important part of building credit. The next most important part is called your capacity. That's 30% of your score. So what your capacity is it's your revolving credit. So that's your lines of credit, your credit cards, home equity line of credit. Basically, if you take all of those credit limits and add them together, you have your total capacity. Let's say your capacity is $1,000. You have the capacity to spend $1,000 at any point in time. The higher your balances are on those revolving lines, the lower your capacity. So if you constantly have $500 on your credit card, on your $1,000 credit card, your capacity is only at 50%. The closer your capacity is to 100, the better your credit's going to be. And if you're in a spot where you want to improve your credit quickly, the easiest thing to do, or the quickest thing you can do, is pay down all of your revolving lines. If you pay all of those down to zero, your score could jump up close to 100 points, depending if you're maxed out or not. The next most important part is the length of credit. So 15% of your score is basically just based on how long you've had trade lines in your name. So if you just took out a loan and you take out a second loan and a third loan, you're not going to have a good score overnight because they want to see that the loans that you do have in your name have been in place for a significant amount of time. If you take one out and pay it off after 6 months, it'll actually work against you. If you were starting off with zero, there's nothing in your name, you weren't added as authorized signer on your mom or dad's credit card, then it's going to take at least 6 months for you to start reporting that first score. So if you do your first loan, some people are like, oh, I'm going to just do this and pay it off as quickly as possible. If you do that, you potentially just end up with no score again after doing your loan and paying interest. You want to take it out for at least 6 months to start reporting a score, and then take it out for another 6 to 8 months to really build on that score and make on-time payments on that score. Next, you got the accumulation of debt in the last 12 to 18 months. So that's 10% of your score. So you'll see this come into play I've seen it come into play mostly with like older, maybe retirees, where they've done mortgages, they've done auto loans, multiple home equities, but they've paid everything off. They don't have any credit cards, and they haven't done anything in the last 12 months. They come in to do a small personal loan for a gift or a vacation. They find out they have no score anymore because they haven't done anything. So it's just as important to keep active as it is to make sure that you're not doing too much. So you want to have at least a credit card that you use once a month to keep your score from disappearing. Because if you don't do anything for 18 months, it's gone away and you have to start all over. Lastly, 10% is a mix of credit. So what that is, there's two different types of main credit. There's revolving and installment. So a personal loan, an auto loan, that's an installment loan. If you're making a $500 payment every month for 60 months, 5 years, and then it's done, it's paid off. A credit card is a revolving loan. So you have a $500 balance or a $1,000 balance that you can use and pay down for an infinite amount of time. As long as you have money on it, you can use it. It's just revolving. It's going on. So they want to see that you have a good mix of those two different types of credit. If you only have revolving a bunch of credit cards, your score is not as high as it could be. You want to see have a good mix, a couple credit cards, a personal loan or an auto loan or a mortgage. If you have a good mix, that's how you're going to get your highest possible score. So I know there's a lot of little things, but basically the two things you should focus on, if all you're going to do is focus on two main things: pay your stuff on time, don't max out your credit cards. If you do those two things, your score is going to be totally fine and you'll qualify for whatever you want to qualify for.